Imagine two superheroes, Invesco QQQ and Schwab SCHD, both beaten at the same time. That sounds hard to believe, right? But when you look at the data, it actually happened. There is one ETF that over the past 5 years delivered higher total returns than the NASDAQ 100 ETF, while also paying a higher dividend yield than SCHD. That ETF is iShares MSCI Europe Financials ETF. In today's video, we'll start by looking at what this ETF actually is and what it holds. Then we'll break down the 5-year performance to understand why the numbers look so impressive. After that, we'll zoom out and examine the long-term picture, including drawdowns and dividend stability, to see where the risks really are. And finally, I'll explain how this ETF can be used in a portfolio and why timing and position sizing matter far more than most investors expect. A quick disclaimer, this video is for educational purposes only and not financial advice. Without further ado, let's get started. EUFN is an exchange-traded fund that tracks the MSCI Europe Financials Index. It provides exposure to European banks, insurers, and financial services companies across developed markets. One important point to clarify is that EUFN is not a small or experimental ETF. It is issued by BlackRock, the largest asset manager in the world, through its iShares platform. As of late 2025, EUFN manages around $4.6 billion in assets and has been trading since January 2010. That makes it a large institutionally used ETF, rather than a niche product. The expense ratio is 0.49%, which is slightly higher than many US-based ETFs, but reasonable for a fund focused on European financial stocks. EUFN pays dividends on a semi-annual basis, which reflects how European financial companies typically distribute earnings. When you look at the holdings, the fund is clearly sector concentrated, but it owns some of the largest and most systemically important financial institutions, including HSBC Holdings, Allianz, Banco Santander, UBS Group, and BBVA. These are established banks and insurers operating across retail banking, investment banking, insurance, and wealth management. The top 10 holdings make up roughly 40% of the fund, which means EUFN's performance is driven by a relatively small group of dominant players. So when you invest in EUFN, you are not betting on Europe as a whole. You are making a focused bet on the profitability of European financial institutions and on the broader interest rate cycle. That concentration helps explain both EUFN's strong short-term performance and its long-term risks. When you focus on the 5-year period from the end of November 2020 to the end of November 2025, EUFN looks extremely compelling. Over this period, EUFN delivered an average annual dividend yield of around 4.13%, outperforming the US dividend favorite SCHD, which returned about 3.37%. In terms of capital growth, EUFN's roughly 151% gain over the same window also exceeded the performance of the US growth benchmark, QQQ. When you put those two components together, capital growth plus income, EUFN's total return profile over this 5-year window looks unusually strong. That combination is exactly what makes the fund stand out on a short-term performance chart. This result was driven by several powerful forces that all aligned after 2020. First, interest rates in Europe moved sharply higher after years of being near zero or negative. For banks and insurers, this change directly boosted profitability by expanding net interest margins and improving returns on capital. Second, the post-pandemic recovery allowed banks to release loan loss reserves built up during COVID, while credit demand normalized. By 2022 and 2023, European financial institutions were reporting some of their strongest earnings in more than a decade. Third, shareholder payouts increased meaningfully. Dividends were reinstated, raised, and supported by aggressive share buyback programs across Europe. That pushed EUFN's income component higher at the same time that prices were rising. Finally, valuation played a major role. European financial stocks entered this period trading at deeply discounted levels. As earnings recovered and sentiment improved, those valuations moved higher, amplifying capital gains. So over this 5-year window, EUFN benefited from rising rates, recovering earnings, strong dividends, and valuation normalization all happening at once. And when you look only at this period, it's easy to conclude that EUFN offers the best of both worlds, growth and income. But this is also where context becomes critical, because when you extend the time horizon beyond these 5 years, the story changes substantially. When you step back and look at the full history of EUFN, the story changes materially. Since its launch in 2010, EUFN's cumulative price return is roughly around 200%. In simple terms, the fund has approximately tripled over more than 15 years. That is not a poor outcome in absolute terms, but when you compare it with long-term growth benchmarks, the difference becomes clear. Over the same period, QQQ delivered well over 1,500% in cumulative returns. The gap is not explained by one bad year or short-term volatility. It comes from how returns are generated over time. The long-term chart also reveals another important feature. For much of the 2010s, EUFN's price moved sideways. During the European sovereign debt crisis earlier in the decade, banks were hit by fears of government defaults, weak economic growth, and years of balance sheet repair. That period was followed by a prolonged era of ultra-low and negative interest rates, which severely compressed bank profitability and capped returns on equity across Europe. Then in 2020, EUFN fell sharply again during the COVID shock. European banks were forced to build large credit provisions, regulators restricted dividend payments, and confidence in the financial system deteriorated almost overnight. As a result, EUFN's price dropped back to levels last seen around 2012, effectively erasing nearly a decade of price progress. This highlights a structural reality. EUFN is concentrated in one sector, financials, and the financial companies are inherently cyclical and highly sensitive to macroeconomic stress. When conditions are supportive, rising interest rates and improving credit drive strong rebounds, like the ones seen after 2020. But when growth slows, rates fall, or financial stability is questioned, losses can be deep and recoveries can take many years. The same pattern appears when you look at income. Over the long run, EUFN's average dividend yield has been attractive, sitting at around 4.0% to 4.1%. But the absolute dollar amount of dividends has not grown smoothly year after year. Dividend payments fluctuate significantly and are closely tied to the financial cycle. The most striking example is 2020, when EUFN's annual dividend collapsed to roughly 24 cents per share, following regulatory restrictions on European banks. Dividends later rebounded strongly as profitability recovered, reaching over $1 per share again by 2024 and 2025. But this recovery does not change the underlying pattern. EUFN's income comes in waves. It rises quickly in favorable conditions and can fall sharply when stress appears. By contrast, SCHD has historically delivered a much steadier income profile, with dividends growing gradually across multiple sectors rather than relying on one cyclical industry. The key takeaway from the long-term data is this: EUFN does not compound steadily. Its returns depend heavily on timing, valuation resets, and macroeconomic cycles. That does not make it a bad ETF, but it does mean it behaves very differently from funds designed to deliver long-term compounding or stable income. And that difference is something investors need to understand before being impressed by any 5-year snapshot. To use EUFN properly, the first step is understanding what it is and what it is not. EUFN is not a long-term compounding engine. It is a cyclical, sector-specific ETF whose returns are driven by interest rates, credit conditions, and valuation resets in the European financial system. That means performance depends heavily on when you own it, not just how long you own it. This is why time horizon matters so much. 5 years can look exceptional if it coincides with a recovery phase, like the period after 2020. But over full market cycles, returns tend to arrive in bursts rather than compounding smoothly. The second key point is concentration risk. EUFN is diversified across countries, but it is concentrated in a single industry. When financials struggle, most holdings tend to struggle at the same time. Because of that, EUFN works best as a satellite holding, not a core position. For most investors, the core of a portfolio is still better anchored in broad U.S. exposure, such as SPY and QQQ, which benefit from structural earnings growth and long-term reinvestment. EUFN can then be added selectively as an opportunistic allocation. It can provide diversification away from U.S. equities and offer higher income during favorable parts of the cycle. Valuation matters more with EUFN than with broad market ETFs. Historically, the most attractive entry points have occurred when European banks were deeply discounted, sentiment was weak, and profitability was depressed. In those environments, improving fundamentals and rising rates can drive powerful recoveries, both in price and dividends. What EUFN is not designed to replace is a diversified dividend strategy. Although its yield can be high, income is cyclical and can be reduced sharply during stress periods. Investors seeking reliable and steadily growing income may prefer broader dividend-focused funds like SCHD, while using EUFN selectively for yield enhancement rather than income stability. So the right way to think about EUFN is as a tool, not a foundation. Used thoughtfully, it can enhance returns and income when conditions align. Used as a core holding without regard to cycle or valuation, it can introduce more risk than many investors expect. And that brings us to the final takeaway. iShares MSCI Europe Financials ETF is a solid, well-constructed fund. It is large, liquid, professionally managed, and backed by some of the biggest and most important banks and insurers in Europe. European financial institutions themselves are not weak businesses. In the right environment, especially when interest rates are rising and credit conditions are improving, they can be highly profitable and very generous to shareholders. And that is exactly what we saw after 2020. But strength does not eliminate risk. EUFN is concentrated in a single sector, and financials are inherently cyclical. When conditions turn, banks tend to fall together, dividends can be cut, and recoveries can take years rather than months. That means EUFN is not a set-and-forget investment. Its long-term performance depends heavily on timing. Buying when valuations are depressed and sentiment is weak has historically mattered far more than simply holding through every cycle. Used thoughtfully, EUFN can be a valuable satellite holding. It can add diversification, provide higher income during favorable periods, and benefit from cyclical rebounds in European financials. Used without regard to concentration or timing, it can introduce more risk than many investors expect. So the takeaway is not that EUFN is good or bad. It is that EUFN is specific. It rewards patience, discipline, and buying when others are pessimistic, and it punishes complacency when conditions change. Understanding that difference is what separates short-term performance from long-term outcomes. If this analysis was useful, hitting like really helps the channel. And if you're interested in research-driven investing content without the hype, you can subscribe for more videos like this. Thanks for your time today.